Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we are going to be discussing the biggest fundamental events analysis and case study. In a previous presentation, we explained about the three styles of trading Forex: fundamental, technical analysis, and trading with market sentiment. In this presentation, we are going to look at the significance of fundamental analysis in more depth. Fundamental analysis is the way that traders try to analyze the economical, social, and political events in a country in order to ascertain its exchange rate with another country's currency. Therefore, traders will be interested in the gross domestic product and growth potential of a country, along with the other factors such as unemployment rate, debt, inflation, and monetary policy. In the case of the US dollar and the euro in particular, traders will also be trying to gauge supply and demand of these currencies. Of course, in the real world, all of these factors are extremely fluid and change constantly. Traders are constantly battling in order to determine the value of one currency against another. In other words, the currency exchange rates. When a country releases economic data, especially interest rate changes, GDP announcements, and in the case of the United States, unemployment changes in the form of non-farm payrolls, which are normally released on the first Friday of each month, these data releases will be greatly anticipated and can dramatically change the value in a country's currency and thus related exchange rates. We often find the dramatic Forex market moves caused by the increased volatility surrounding such events. Case Study 1. On the 23rd of June 2016, the British voted a referendum to leave the European Union, Brexit. This sent shockwaves through the financial markets and resulted in the British pound plummeting in value against its peers. In example A, we can see a huge red bearish Japanese candlestick descending from a high of over 1.50 to a low of 1.32 against the dollar. This was during overnight trading post the referendum result. The subsequent uncertainty regarding the decision caused the pound against the US dollar, also known as cable, to fall to a low of 1.19. Indeed, we are still seeing extreme volatility due to the fact that some 3 years later, this matter has not been yet concluded. While many traders correctly predicted that the British public would indeed vote to leave the European Union and shorted cable, and made a hefty profit as the pound sank, traders who were long of the pair faced huge losses, and where stop-loss orders would have faced immense slippage due to extremeness of the fall. In example B, we can see some of the extreme moves in cable from a high of 1.50 before the Brexit referendum to lows of 1.19 and swing to highs of 1.43 post the referendum. Obviously, fundamental events like this don't happen often. However, let's look at another fundamental event which caused huge market volatility. Case study number 2. The country of Switzerland lies in the heart of the euro and does a great deal of international business with Euroland. The Swiss National Bank, or SNB, is responsible for monetary policy for Switzerland but declined to join the European Union, preferring to remain an independent trading nation and retain its own currency. Because of Switzerland's geographic proximity to Europe and the significance of trade reliance, on the 6th of September 2011, due to the extreme volatility in the financial market, the SNB announced it wanted to depreciate the Euro-Swiss franc currency, or to cap it at 1.20, so as to remain competitive with regard to trading with the euro area. However, on the 15th of January 2015, the chairman of the board of the SNB, Thomas Jordan, unexpectedly announced that he would remove the cap. The result in the effective 1.20 peg being removed without market notice caused chaos in the Forex market. Next we have example C. We can see a huge fall in the value of the euro to the Swiss franc from 1.2 to 0.96 on our chart. While some brokers were seeing falls as low as 0.85, many hedge funds made huge losses and individual traders were made bankrupt along with the broker Alpari Trading, who could not cover losses it sustained in the devaluation crisis. Remember, this event was a bolt out of the blue with many commentators accusing the SNB of gross negligence. The upshot is that trading on fundamental news releases can present some fantastic trading opportunities. However, novice traders are strongly advised to stay on the sidelines during these events for the following reasons. 1. Increased possibility of huge fluctuations in exchange rates. 2. Price action acting in contradiction to technical analysis. 3. Price already factored into the fundamental news release resulting in little action or movement. 4. Market disappointment resulted in unexpected swings in price action. And 5. A lag in price action while markets assimilate data, and where this can often cause price spikes and reversals. Therefore, unless a trader is highly skilled with regards to trading on fundamentals only, our advice would be to take note of data releases and then wait until such time as the markets have returned to the normal ebb and flow, then continue trading via technical analysis. If you enjoyed the video, please like and subscribe and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.